Hey everybody, in this video we're going to take a look at our homework problems from chapter 7, 7.1 to 7.4, and in this video specifically we're going to start with 7.1. So in 7.1 I've pasted in a little snip of the problem, and I'm going to take the grid lines off there and I'll help you make a spreadsheet to solve our question here. So on 7.1, it says that we have this company, we got credit sales of this amount. So credit sales meaning that they were on account, we got accounts receivable and sales, not as opposed to cash sales essentially. So we had credit sales of that much and cash sales of 1 million. So total, sales, and I'll just start writing this out. I always find it's helpful to have the different variables for accounting problems in a spreadsheet. So let's just start putting stuff in here. So credit sales was 2.25 million. Cash sales was 1 million. We're missing a 0. There we go. And then total sales then is the sum of those two, or 3.25 million. At year end, let's say our AR balance was 600,000. I'm not 100% sure we'll need every figure, but let's just get them in here. If we do, we can analyze them easier with it in Excel. And we had allowance, and actually I'm going to do the allowance for doubtful accounts as a T account, just so we can look at that and potentially need to factor in that if we do an AR method allowance calculation. So we'll say allowance for doubtful accounts. Okay, and it tells us that we have a $5,000 debit balance in the allowance account. So in one essence here too, so this is our debit balance, right? And an allowance for doubtful accounts has a credit normal balance. And so this is kind of in a way saying we have a negative allowance for doubtful accounts balance. And so likely that's related to certain write-offs during the accounting period, etc. And so we're going to have to factor that in when we do our new balance transactions here. Okay, and let's look at the question here. So what journal entry is required to bring under each of the following independent assumptions, and show the balance sheet presentations for part I and triple I guess. Okay, so let's take a look here. So let's do number 1. We'll just call it number 1. And if we have an estimation of 2.5, so I'm going to put in 2.5%, and that's credit sales uncollectible, then we're doing the sales method in this instance, right? So we don't have, with the sales method, we don't have to really care about this when we're calculating our allowance. And essentially what we'll do then, we have credit sales up here. So we're going to take the 2.5 times the full amount of the credit sales, or 56,250, and then that will become our bad debts expense. So just got a text here. Okay, so that will become our bad debts expense. And so the journal entry under this one then will be, let's say this is our account section. This is our, I'm going to bypass doing the date and just do the debits and credits. So again, we have you've seen this in the exercises, so bad debts expense and in class, and then our credit is to allowance for doubtful accounts. And I'm just going to put these over a little bit farther. Let's do it like this: debit and credit. So those are more easily sized the same. So this will be our journal entries here. This is our credit, so let's indent that a little bit. And that's where we get 56,250. And just for the heck of I'm going to merge these, put the formatting back that way. This is going to be a better looking general journal for us here. And let's go ahead and just make this look like a general journal. Actually, I'm going to make it relatively small. We'll just copy it for the other ones down. Let's merge these, format there. Oh, let's do our indentation again. And let's say estimate bad debts, and we'll just say 2.5% credit sales. Okay, so that's our journal entry that we would need. And then in this instance, if we wanted to take a look at what the allowance would, do basically in this scenario. So we had a debit balance of 5,000. Here we're crediting for 56,250, and so the ending balance of allowance for doubtful accounts in this instance, then we would take our larger, credit minus the debit. We would end up with a credit balance of 51,250, and I'm going to include this all together here for showing the balance sheet presentation. So let's see, let's put in balance sheet presentation, and that would be accounts. Yeah, I'll just write out accounts receivable, and then allowance for doubtful accounts. And again, this is on our balance sheet in the assets section. And then we would have net accounts receivable. And the way that this would look, you'd have cash and other things and prepaids and other stuff, but this is just under the assets section. So just for the accounts receivable part, we would have, why does that show up there? Accounts receivable total at the end of the year here is 600,000. And then we would have our allowance for doubtful accounts credit contra asset account, and then that gets us a net AR of 548,750. So this is the portion we think the portion that we think we are not going to collect, and we are more confident that we're going to actually collect this amount. That may prove wrong, but this is our best estimate for based on historical collections and just company experience essentially. Okie dokie. So I'm just going to copy all this down. This will be part 2. In this one, we're going to say that we estimate 1.5% is uncollectible of total sales. So we're not just credit sales here, but we're going to do total sales. And so then in this instance, we're going to take 1.5 times total sales, and that gives us 48,750. And let's see, we'll just update our explanation. And you can see how kind of nice copying and pasting this stuff is in, because it puts everything together quickly. And that it basically, sets things up for us. And so this again just is the same, but a different allowance. And so if we take 1.5% of total sales, that gives us 43,750 as opposed to 2.5 credit sales. And that's our net accounts receivable on the balance sheet, just like we did above. And yeah, that's pretty much everything there. Again, we're doing the sales method, so no need to, adjust it didn't tell us to do the balance sheet for 2, but that's fine. I'm just going to leave it because I already have it. So if that was the balance sheet, that's what it would look like. And let's move on to the third assumption here method is 6% of AR is uncollectible. So we're doing the AR aging method now. And so we're going to take our 6% not times sales anymore, but by the outstanding AR balance of 600,000, which gives us 36,000. And then this is the method where we have to analyze, we'll say 6% AR. Here we have 36,000, and that's our target. So we want to end up with an allowance for doubtful accounts of 36,000. With the sales method, we just add whatever we calculate in, and it ends up less because we already had a debit balance. But here, regardless, of the debit balance, we want this to be 36,000. We want it to end at 36,000. So that means that our journal entry is not like this, but instead it's 36,000 plus 5,000, because we've got to get the 5,000 to zero that out first, and 41,000 credit balance minus a debit of 5,000 gets us to the target balance of 36,000. So in other words, again, our number there is 41,000 to get us to end at 36,000. So that's the important distinction between the two different methods. And that we need to factor in what is the current balance in the allowance account when we're doing the AR method. Okay. And then same thing, we got 600,000. Again, this is what we were shooting for. Our target was to end with a $36,000 allowance for doubtful accounts. That's what we did. And our net accounts receivable is that amount. I think that's everything it asks us to do here. So a good comparison of the different types of methods and the balance sheet presentation as well. And another area where you see something similar, again, we've talked about contra asset accounts with accumulated depreciation. And so it's kind of similar. You'd see, plant, property, and equipment account type accounts, equipment, vehicles, buildings. And then you would have accumulated depreciation, reducing those values to get to a net book value of plant, property, and equipment. So somewhat similarly, we have an asset here as the accounts receivable. They're different things. They represent different things. This is us representing the portion we estimate to be non-collectible of the amounts outstanding owed to us, whereas PP&E, accumulated depreciation, is just the effect of the PP&E, plant, property, and equipment being worn down over its useful life. But in both instances, we have a contra asset, an original balance, an asset balance with a contra asset to get us to a net balance that's lower. So, all right, that's problem 7.1, and I'm going to move on to the next problem here in the following video. Thanks, everyone.